Oh, and welcome to the session in which we will discuss life insurance policy. But before we discuss life insurance policy, let's go back to the prior session. In the prior session, we looked at various types of risk mitigation, which was what? Risk avoidance, risk transfer, risk reduction, or risk retention. So one of the risk mitigation is risk transfer. And when we discuss risk transfer, think about insurance. It's when you shift the risk to another party, often through some sort of an insurance contract. When to choose risk transfer, we said when the frequency of the event happening is low. It's not going to happen. There is a low frequency, but the severity is high. And we looked at various examples, such as a contractor transferred the risk of construction accident to an insurance policy, renting a car with buying an insurance in case of an accident, in case of medical emergency. What will be also an important example for low frequency, high severity is a death of a person. So if a person passes away and they have a family, well, guess what? The chance of passing away, this is 100% certain at some point, but you cannot time it. So the frequency could be low, but if that happens, the severity for the family is high. Therefore, what's going to happen to mitigate this risk, we are going to buy some sort of an insurance. Specifically, what insurance? Life insurance. So in this session, we will discuss life insurance as a form of risk transfer. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
What is life insurance? Well, it's designed to mitigate the financial consequences of death, which is known as, the technical word is mortality risk. Simply put, the person passes away prematurely, they have a family, they have kids, they haven't went to college yet, they have a mortgage, and they have other debt, and they don't want to keep their family with all this debt. This type of insurance plays a crucial role in financial planning, especially with those with dependent. If you have kids, well, how are you going to protect them? Who's going to provide for them? Well, if you have a life insurance, this could mitigate this risk. So the purpose of the life insurance is to do what? Serves to provide financial support to the dependents of the insured after their death. And what type of support are we looking at? Well, there could be cash value, income for survivors, to ensure that the dependents continue to receive some sort of a financial support. If you have any debt, it will pay off your debt. You could have funeral cost, it will cover the funeral cost. If you have any education expense, it will also, if they have any education expense, it will also pay for that. Your education expense might be part of the outstanding debt, but it will also have money for their college education. Simply put, you want to protect your family if something happened to you. What do? You buy life insurance as a form of risk transfer. Now, insurability of the client, what does that mean? It means as an individual, when you apply, they would review your suitability, whether you qualify for the insurance, and if so, how much premium do you pay? So sometimes you may or may not qualify altogether. This refers to the suitability of a person for life insurance, and they looked at your health, age, and lifestyle. For example, if you smoke, drink, you don't have a healthy lifestyle, they may not insure you because the probability of death is higher. Therefore, they would say, and if they do so, the cost might be prohibitive, where it's not worth it. So it's not every person that apply for this insurance will qualify. So insurability is a key in personal financial planning because it determines whether the client can obtain the life insurance, and if so, at what cost. If a client needs health insurance for any reason, their level of suitability will greatly influence the options available to them. So it depends on you. For example, one individual could have a life insurance premium. They have to pay $4,000 per year. Another person pay $2,000 per year. Another person might have to pay $15,000 per year for the same policy, depending on that individual health, lifestyle, age, and other factors. There's an underwriting process. Underwriting means they review your situation. Before issuing this contract, they would review your situation. And what they do, they would look at the risk associated with you as a person. They would evaluate your medical history. They would look at the past 10 years. You've been in the hospital. What type of medication are you taking? They will have a blood test. They will look at your blood pressure, so on and so forth. They will send someone to your home actually and, take the blood, ask you a few questions about your situation. There's something called life insurance riders. If you want additional benefit, those are riders that can be added. It's a contract. It can be suited to your own need. So the policy, riders enhance the policy by providing extra protection or features that you think you need for yourself and your family. So when it comes to life insurance, there are two types of life insurance contract. There is term life insurance and there is a permanent. Or permanent, we're going to see under permanent, basically we're going to equivalent it with whole, but we're going to talk about this. The first one is term life. Term life, one. This is a temporary form of insurance that could cover up to 5, 10, 15, 20 years. So you choose in the contract for how many years you're going to pay for this. And sometimes the payment is fixed. Sometimes this payment is variable. So for example, that's it. I'm going to pay $3,000 per year and I'm going to be covered, for example, for $1 million. That's the deal. Now, term life insurance is typically less expensive, but it does not accumulate any cash value. So you have this protection for a period of time, but once that period of time is over, if you want to renew it at this point, let's assume you purchase a policy for 20 years, you're 40 years old. 20 years later, you're going to be 60. And let's assume you survive until you're 60. Now, when you want to purchase again, buy another insurance policy, it's going to be more expensive because you're closer. Closer to what? Closer to your mortality as you get older. Then we have a permanent life insurance. This type of insurance provides coverage for the insured for their entire life, includes an investment component which builds cash value over time. If the permanent life insurance does accumulate cash value, then we call it whole life. So when we say permanent, it's not equivalent of whole life, but if it's for the full life and it accumulate cash value, we call it whole life. It's a type of a permanent life insurance. Now there's a whole life, there's universal life. We don't have to worry about the difference, but if it accumulate cash value, we're gonna call it whole life. So let's start by discussing term life, then we'll discuss the permanent life insurance. Term life, as I told you, it's the nature of the coverage is limited, is for a specific time. Think of it as renting a car for a period of time. You pay to rent the car, let's say 2-week road trip. What do you do at the end? You'll bring back the car. What do you get for the payment? Nothing. You already used up the payment. This is the same way as having term life insurance. You could cover you for 10, 20, 30 years, whatever the term is, the contract. But after that, let's assume you bought a policy for 30 years. 30 years later, if you survive, you get zero. There's no ownership or value accumulation, just like you rented a car, or a gain of any value after the rental is over. But guess what? Let's assume you passed away at year 29 or year 15. Let's say you have a 30-year policy. You'll get the payment for the beneficiaries. Beneficiaries is the people who's going to get benefit from that policy. Otherwise, there is no ownership. You have simply covered yourself for that period. You are covered in case something happened. But in case nothing happened, basically you lost. As if you rented a car or rented a home. What happened at the end of the term? Nothing. If the policy is done, it's done. Imagine your road trip gets extended. You need to keep the rental car longer, that's fine. If you need the insurance coverage beyond the initial term, you'll have to renew it or purchase a new policy. And as you get older, the price gets higher. As your health deteriorate, it gets more expensive. But just like cost might increase over time, the premium for a new term policy are likely to be higher, especially as you age. If your policy is no longer needed, if your car trip ends as you planned, you return the car and you stop paying fees and you lost all the premium. Likewise, if you no longer need the insurance coverage after the term ends, maybe your financial responsibility have decreased, the policy simply expire. Now, when do you need this? When should you use this term life? Well, if you need it for a limited time, like 5, 10, 15 years, just like you would rent a car for a specific journey, term life insurance is suitable when you have a specific need. For example, let's assume you're in the 40s and you want to cover yourself from 40 to 60 in case something happened. You will buy term life. This is just because this is what I needed at 60. I will see what I'm going to do at that point. This can include ensuring financial support for your children's education or covering a home mortgage. Maybe in 20 years, your home is paid, your kids out of college, then you have different consideration. The best thing about the term life, it's cheaper. It's cheaper. Renting a car can be a budget-friendly option compared to buying one, especially for short term. Same thing with term life insurance. Term life insurance is often chosen for lower initial premium compared to the permanent life, making it more feasible option for those with limited budget because you don't want to pay too much. This is why you will choose a term life. So to summarize, term life is cost effective to provide financial support for a specific period of time, very similar to renting a car. It offers a temporary transportation solution. It's an ideal choice when you have defined financial obligation that's going to decrease over time. Like when you pay your mortgage, your kids out of college, you have less expenses. Then you would look either to extend the term life or buy permanent or whole life insurance. And this is what we'll discuss next. Whole life is different. Whole life or permanent life, again, as I said, the way we define permanent life here, we mean whole life. Permanent life insurance can be compared to buying and owning, let's assume, a car or a home. Unlike renting a home or a car, owning a home allows you to build equity over time. Same thing with the insurance policy, that's whole life. It accumulates value. Buying equity, building equity in your home. When you buy a home, over time you build equity as you pay off the mortgage. Eventually the house is fully paid and you own it outright. Same thing with whole life insurance. Permanent life insurance accumulate cash value over time, and this is the same thing, similar in concept. Now this is all in concept of buying equity. So as you pay premium, so what happens is this, you have to pay premium every month or every year. You pay premium into this policy, and this premium basically builds a value. There's a value. This money is invested in stocks and bonds, and it's building value. Versus term, when you pay, it's basically, this is rental money. It's gone. The whole life, it accumulates, contribute to the policy cash value, which grows over time as you put in. That money is also earning dividend and interest because this money is invested by the insurance company. At some point, it's invested large enough that the dividend and the interest, it's going to offset the premium. So rather than you paying, it will start to pay for itself. If we go back to the mortgage example, imagine reaching a point where the mortgage is fully paid and you no longer have to make mortgage payment. Well, if you have enough money in that insurance policy and that money is invested and generating dividend and interest, the dividend and interest will either reduce your premium that you pay every year or it might pay for it altogether. Here, the policy accumulates cash value that can be used to pay the premium. However, there's no guarantee and it depends on the policy's performance and dividend. So in other words, what did they invest in? They have to invest in something. If they did not invest in the right investments, then there is no return, there is no interest, there is no dividend, therefore there is no premium offset. What are the tax benefits? Well, just like owning a home, you enjoy certain tax benefits like deduction on taxes and mortgage. For the insurance, the cash value in a permanent life insurance policy grows tax-deferred. Tax-deferred means what? You don't have to pay taxes on that. Also, dividend, if the policy pays them, are generally tax-free. Funds from policy, another benefit, has a favorable tax treatment, similarly to how homeowners can benefit from certain tax deduction. Now, can you access the fund? Remember, you're putting that money into that cash value. Can you get this money out? And the answer is yes. How can you access it? You can access it through a loan. Just like if you have equity in your home, you can take out a loan against that equity. Same thing if you have this policy. You have this money in an account, and a permanent life insurance, you can take loan against that policy. And the insurance company will have no problem giving you the loan if you have, for example, $10 million or $5 million and you want to borrow $500,000. Well, guess what? They have no problem giving you this money because it's being loaned against your policy. The money is there, so you can access it. So you could use the money as a collateral. Also, it's a great feature or great tool for estate planning for high net worth individual. Homeowners might use equity in their home for various estate planning purposes. Same thing, high net worth individuals often use the permanent life insurance as part of their estate planning. Now, the policy proceeds can be used to pay estate taxes, ensuring that the heirs, the people that survive you, receive the intended inheritance without the burden of large tax payment. So you could use this money to pay estate taxes as well. Now, obviously, when this money is paid to the beneficiaries, it's also tax-free to them, which is good. To summarize, permanent life insurance is like owning a home, owning an asset. It offers long-term financial security because it's forever and has the ability to build and access cash value and comes with certain tax benefit. It's a useful estate planning for high net worth individual. However, one disadvantage of it, the cost of it could be high. The cost of it could be high. And that's why people opt for what? For term at the beginning until their financial situation improves. They have more money to pay for life. They will switch to life. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following is a tax benefit of a permanent life insurance? Permanent, as I mentioned, you can equivalent it to whole. It doesn't have to be, but we can think of it under the circumstances. The tax benefit. So it's only, there's going to be one of them, tax benefit. Dividends are always subject to immediate taxation. Withdrawals are always tax-free. Accumulate value grow on a tax-deferred basis. Premium payment are tax-deductible. Let's start with D. Are premium payments tax-deductible? And the answer is no. If you bought an insurance policy, life insurance, and you're paying premium, you cannot deduct that premium on your taxes. That's out. Dividends are always subject to immediate taxation? No. If the dividends are paid, oftentimes they are tax-free, so are not always subject to immediate taxation. B and C. Withdrawals are always tax-free. Not always, if they meet certain conditions. Therefore, the word always, take them out. We're left with C. It accumulated value grows on a tax-deferred basis. And the answer is yes. When the value of that policy grows, it grows without being taxed. So you don't have to pay taxes on that value. Therefore, the answer is C. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you do what? Understand this concept better. For tax planning and compliance CPA exam for enrolled agent, you want to understand the difference between life insurance, whether it's term or whole life or permanent. Good luck, study hard, and of course, stay safe.